Tom, thank you for being with us again to talk about trends in the economy. This is our last video interview of the year. We wanted to use our time with you today to get you to look back across 2021 and assess how the U.S. economy performed. In a lot of ways, it was really an amazing year in terms of economic performance here in the U.S., but there was a lot of volatility, and it feels like there's a good deal of uncertainty when we look ahead into 2022.
Well, it's been a wild ride to be sure, but we've landed in a place that's much better than anybody, including me, would ever have anticipated.
To that point, let's bring up an illustration that shows just how much actual performance differed from what the projections were for the U.S. a year ago. So here's a chart that shows three key economic indicators: GDP and unemployment and inflation. On the left is a bar that shows what the Fed projected, the Fed median was a year ago for each of these. And then on the right is the actual performance for that indicator. When you look at this, what's your reaction considering where we were 12 months ago?
The simple answer is things turned out much better than we expected, right? The economy grew more than we thought it would. The result of that was unemployment went down much further and much faster than we thought. And guess what? We have inflation, which we haven't had since I graduated from high school, which is now some time ago. So we have outperformed on all these macroeconomic indicators, and probably the single unifying thread across how could this be was the fact that we didn't have ubiquitous, effective vaccines when these projections were made. And that has been the single biggest contributor to economic activity reviving more vigorously and more quickly than we anticipated a year ago.
I want to ask you about a theme that I think is out there that relates to government stimulus and the withdrawal of stimulus that's happening in the economy right now. On the fiscal side, you've had a lot of COVID-related relief programs go away. And on the monetary side, we do seem like we're facing the prospect of tightening now because of concerns about inflation. How big of a deal is that? And how much of the really strong growth that we've had over the past 12 months has been related to stimulus versus the underlying strength of the economy?
Well, it's been all of the above, right? We've clearly had a great deal of fiscal stimulus, and we had monetary stimulus even before that, right? So our authorities here have been more quick, more comprehensive, more responsive than almost any other country in the world. But it's all happened more quickly because the vaccines came along so quickly. So the application of this fiscal stimulus is much less necessary now than we thought it was going to be because of these ubiquitous, effective vaccines coming along so quickly, and because of the impact of economic activity reviving so quickly. That has created all kinds of bottlenecks in the supply side of the global economy, quite frankly, which is exacerbating the inflationary impact, which I think, frankly, has a complexity of macroeconomic connectivity that none of us have seen in our adult lives, and is a little bit unexpected, and we probably don't fully understand it, but we do know that we're seeing it, experiencing it, and measuring it, and must deal with it.
Let's go to another chart that shows growth projections that were just released by the Fed. So these are updated. You can see here that after a very strong growth this year, we do, according to the Fed, start to trail back down to kind of a 2% level over the next couple of years. Is this just basic mean reversion here, or is there any reasonable scenario where maybe enough change in the economy has happened where the natural rate of growth might be a little higher than the 2% that we've gotten used to?
It's a great question. I would be confident in saying we're not going to grow at 5.5% on a going forward basis. We're probably not going to grow at 4% on a going forward basis. We will settle. There will be mean reversion, to be clear. But what will be that future mean? It may not be exactly the same as the pre-pandemic mean was. And that growth spurt may lasts a little longer because there are other phenomena occurring, like people onshoring production, wanting to build more resiliency into their production, be less dependent on imported inputs or finished products from foreign producers and so forth. those kinds of activities take a long time to get completed, and they will, in fact, increase production and inventorying and so forth if you decide you want to have a lot more production onshore. So there are reasons to believe, at least in my opinion, that you could have higher growth for a longer period of time, and that mean reversion process may not happen as quickly as this before you settle to some mean. We can be confident of one detailed thing, which is these projections will be wrong. We just don't know how wrong they will be.
I want to ask you about asset values, and we'll bring up another chart here. So 2021's been a great year for investors and people who own assets. This chart shows the performance of the major U.S. stock indices. They're up between 15 and 25%. Housing values have also continued their upward climb very robustly. How important is this to the performance of the economy? Number one. Number two, how much of this is a direct result of low interest rates versus, again, that kind of underlying strength factor?
A little bit of yes and yes, right? I mean, to a certain degree, the stock market is a bit of a confidence indicator. It's a confidence indicator because this is the market's view based on investor activity of the future value of all these publicly traded companies, right? So it's a view about how much growth there will be in the future and what that means for the companies whose stock people are trading in. But it is true that we have very high asset valuations across the economy, not just in the stock market, but also in property, real estate, and in other things.
Last chart we want you to react to is related to interest rates. So again, a before and after view here. The bottom line there is the Fed's projection for the federal fund rate, their median projection from a year ago, and then the top line is the one they just released. Talk about what this means and what it portends for borrowers and other people who care about interest rates.
What this chart tells you is they realized they were wrong, and that the slide we saw a couple of moments ago that shows that inflation is a lot higher than they projected or expected, that they have an obligation and a duty to do something about that, and they intend to do so, right? So they have moved their expectations of their own activities to raise the federal fund rate much more aggressively and in more increments than they thought a year ago, when they thought they were going to cruise all the way out into 2023 before doing anything. Now they are telling us, and frankly, everyone else in the market is telling us, that rates are going to start to go up in 2022. So for borrowers, the cost of money is going to go up. Right now, with the kind of inflation we have, real returns for treasuries are negative, and the cost of money is negative after inflation. But we are going to get on a path and a trajectory here, which frankly we haven't been on in decades, of dealing with an inflation issue and using interest rates as one of the tools to bring that inflation back into line.
How worried are you about inflation? We talked about it a couple of videos ago, and it was early on when things were starting to creep up. But from right now's vantage point, how concerned are you about it?
I wouldn't say I was sanguine, but you didn't see, last time we spoke about that, you hadn't seen inflationary expectations and behaviors and attributes in business decisions manifesting yet. But we're starting to see that. And therefore, that starts to bake in inflationary expectations and inflationary behaviors that become both harder to tamp down and take longer to do so. So I am a little more nervous about the inflationary dynamic now than I was a couple of months ago, and I think that the Fed, to their credit, are too, and they are preparing us all to take the sorts of steps that they need to take to establish and reestablish their credibility to get ahead of this rather than be behind it.
Last question for you, which is more of a look-ahead question, and it's focused on the rural economy. You talked to a lot of our customers all across the various sectors that we finance. When you think about 2022 and the year that's coming, how well positioned do you think rural America is and the rural economy is to be prosperous in the coming year based on everything you look at?
Well, despite the stresses and strains, both personally and professionally, that our customers and people in rural America, as well as the rest of the country, have gone through since the pandemic began, which are truly extraordinary, the economy has done better than anybody expected. And frankly, the rural economy in general and the agricultural economy in particular has outperformed expectations, right? Net farm income is expected to go up another $22-ish billion this year, reach the highest level since the last cyclical peak, which was in 2013. Therefore, my view is that the agricultural economy is going to be stronger for a little longer than we had anticipated 6 to 12 months ago. Even though there's a lot of trade uncertainty as the Phase 1 China deal lapses at the end of this year, even though transfers and the fiscal transfers to the agricultural economy are likely to go down meaningfully, balance sheets are really, really strong in the agricultural sector. Prices are robust. Global supply and demand dynamics are favorable. So, people will end this year in a very strong position and enter next year in a very strong position.
Tom, you're a very busy man. We appreciate that you take time out to do these videos and share your views throughout the year. We look forward to more of it in 2022.
Happy holidays, and we look forward to coming back strong next year.